Hi, good evening, everyone. My name is Gerald, and I'll be your moderator for tonight's Corporate Connect webinar. So we are very pleased to have with us Lendlease REIT at tonight's Corporate Connect, as well as the audience from Momo Live. This Corporate Connect webinar is organized by SIAS and supported by the SGX Group. So many of us are probably not unfamiliar with Lendlease REIT. We probably visit a lot of the assets that they hold in the portfolio, assets such as GEM, 313 at Somerset. And what we can also tell is that about 90% of the portfolio of Lendlease REIT is actually in Singapore. So tonight we will have a sharing from the management of Lendlease REIT, where we'll get an update from them about some of their latest developments. And we also welcome questions from the participants. So if you have any questions that you would like to ask the management of Lendlease REIT, we'll welcome them and you can share some of these questions in the Q&A box. But before we welcome the management of Lendlease REIT, what I will do is to provide a very quick market update in terms of some of the developments that we see for the Singapore market as well as the Singapore REITs market. Okay, so what I wanted to do is to first and foremost look at how the Singapore market has done. If I were to look at the performance over the past week, we are now back to above the 4,200 level mark, once again for the benchmark Straits Times Index. So this is actually quite near the all-time high of 4,300 points that was just reached a few weeks ago. And what we have seen in the global markets as well is that the S&P 500 is also close to its all-time high, just below the 6,400 mark. And for the tech-heavy Nasdaq index, with a 3.9% gain in the past week, we are actually at record highs. So generally, there is positive sentiment for global stocks, and we will also dive deeper to understand what is driving this positive sentiment. So this is the chart for the benchmark Straits Times Index in Singapore. I took a longer time series here to observe the trend in the Singapore market. And what we see here is that after the brief dip in April this year with the Liberation Day tariffs, the Singapore market has recovered very strongly. Part of it is driven by the easing of concerns around the global trade tariffs, as some of the negotiations between the different countries and the US have led to a succession in trade deals being announced. But at the same time, the global economy has been more resilient than what some investors have feared. So at this point in time, we have exceeded the previous highs that was achieved in 2007 of about 3,800 points. And I think what investors are at this point looking out for would be whether we see the US Federal Reserve continuing to cut interest rates, and also whether there are any country-specific factors that will help to drive the STI higher. I think when I look at country-specific factors, apart from the easing of trade concerns, we have also seen measures being announced to support the Singapore market. So just a few weeks ago, we saw the MAS coming out with an announcement for more measures to be supporting the Singapore stock market. So what you've probably seen in the newspapers would be the 5 billion equity market development program to strengthen the local fund management ecosystem. And the news that came out would be 1.1 billion of funds that were allocated to 3 fund managers, and these fund managers would invest in the Singapore stock market. So these measures are meant to drive demand towards the Singapore stocks, and together with other measures, including on the supply side, measures to enhance connectivity and trading. All of it is meant to drive interest towards the Singapore market and enhance the entire ecosystem. So we'll continue to look out for more of these measures to be able to drive more interest towards the Singapore market. At the same time, for the 5 billion fund, only 1.1 billion of funds have been announced in terms of how they'll be allocated. We'll continue to keep a lookout for how the remaining 3.9 billion will be allocated between the different fund managers. I think the other factor to keep a lookout for within the Singapore market would be this very sharp fall in government bond yields. So while we have seen the bond yields in the US remain fairly elevated, the 10-year Singapore government bond yield has come down fairly sharply since the start of this year. If you apply for the Singapore savings bond, if you apply for the Singapore T-bill, that's probably something that you would have realized as well, where the bond yields have come down since the start of this year. So currently, the 10-year government bond yield is actually close to the 2% mark, having come down fairly sharply from just about 3% at the start of this year. So with the Singapore market at all-time highs, we often get questions around which are some of the sectors that are still trading at fairly depressed valuations, of which I think if I look at the Singapore REIT sector, it will be one of them. So this is actually the Lion Phillip S-REIT ETF, which represents index, which tracks an index of REITs, and that would effectively provide diversified exposure towards various REITs in the Singapore market. And what we see here is that at this point in time, it has recovered from the April lows, but it is still below the levels where it was at in 2021 and 2022. Okay, if I were to look at some of the recent trends across the different REIT subsectors, we have the URA data that came out a few weeks ago. I think the retail sector is actually one of the more resilient sectors, despite some of the news flow around tenant issues, as well as some of the F&B companies actually facing challenges. So if we were to look at the retail rental index in the second quarter, that actually rose by 0.9% compared to the previous quarter and 1.3% compared to the previous year. If you look at the retail vacancy across both the central area as well as outside central area, all of them have remained fairly resilient. Okay, next we look at the office market. This is where there have been a bit more headwinds compared to the retail market, where we see that the rental index has come down by about 0.3% compared to the previous quarter and 1.4% compared to the previous year. This is largely driven by the increase in supply that we see for Singapore's office market, and that has also led to some of the pressures that we see for the office rents. Okay, next we look at the industrial segment. This is also one of the more resilient subsegments within the various REIT subsectors, where we see that for the all industrial property rental index that went up by 0.7% quarter on quarter, as well as 2% year on year. However, it is worth noting that the rental growth for industrial subsector is actually coming down. So after the COVID-19 pandemic, we saw that the industrial rents went up very sharply, partly driven by the very strong growth in e-commerce demand. And I think in the past few quarters, while the rents are still growing, they have moderated compared to the growth that we saw in 2022 and 2023. Okay, at this point in time, if we were to look at the year-to-date performance of the Singapore REITs, they have been very divergent, really depending on the performance of the individual REITs, whether they've been able to grow their distributions, whether their balance sheet is strong. So at this point in time, we can actually understand more about the different REIT fundamentals, given that the divergence of the Singapore REIT's performance has been fairly wide. It's also worth noting that the price to book valuation of the Singapore REITs has also been very divergent. So we actually have a few REITs that are trading significantly above book value. Those are generally the REITs that have got more defensive assets or seem to have some structural growth drivers, such as the data centers. But at the same time, we also have quite a number of REITs that continue to trade below their price to book value. Okay, so at this point in time, the average of the 40 S-REITs and property trusts in Singapore offer an average dividend yield of about 6.8%. That is above the dividend yield of the STI index and also the 10-year Singapore government bond yield. So with that as a backdrop, I think it's interesting to find out more about individual REITs, given the divergence in performance that we have seen across different subsectors, across different individual REITs, and at the same time, with the fall in the 10-year Singapore government bond yield, the yields that some of these REITs can potentially offer is actually above what we get for the STI index, as well as the 10-year Singapore government bond yield. So with that, I will end my sharing on the Singapore REITs, and I would also then like to welcome the management team of Lendlease REIT to be able to provide an update around some of their recent developments. So we are very pleased to have with us the CEO of Lendlease REIT, Mr. Guy Cawthra, as well as Ms. Teo Lay Ting, Executive General Manager Finance of Lendlease REIT. So I'll hand over to the management team of Lendlease REIT to provide us with an update.
Thanks, Gerald, and good evening, everybody. Thank you for joining us on a Tuesday evening. I know you have choices as to how you spend your free time, so thank you for joining to hear from us. I'll start with just a brief introduction to Lendlease REIT so that we all have a common understanding of the REIT before I run through a presentation. So as you can see on the screen, we've outlined pictures of some of our assets. So Lendlease REIT was listed in 2019, and as you heard from Gerald, about 90% of our portfolio is in Singapore. And that really comprises two very large assets. So there's GEM in Jurong East and 313 at Somerset on Orchard Road. The portfolio value is about 3.8 billion Singapore dollars, and as I mentioned, was listed in 2019. Lendlease is the sponsor of Lendlease REIT and has been active in Singapore for more than 50 years. And I was appointed on the 1st of April 2025 as the CEO of the manager. A bit about myself, I'm originally from the UK, but I've lived and worked in Singapore for 18 years now, and I've worked for Lendlease, the sponsor, for more than a decade in Singapore. So maybe we go to the key highlights. So this presentation that we'll run through today is one of a number of materials that we published online last week. So our financial year ends June 2025. And so last week we announced our financial year results for the full year and also for the second half. On the same day, we announced a number of things. We put out this presentation, which you can find on our website. We put out a press release. We also provided the SGX announcement in relation to the divestment of the GEM office, which I'll talk about today. We published our unaudited financial statements and also a valuation statement on our portfolio. Today, we'll just run through this presentation, but we're happy to answer questions on all of those materials if you have. So just running through the highlights to start off with. So last week, we announced the sale of the GEM office, and the sales price was 462 million Singapore dollars, which is in line with the latest valuation. We plan to use the proceeds from the sale to substantially repay debt, and there's a modest gain on disposal of approximately $9 million, which we intend to make available for distribution to our unit holders. There are many benefits of this transaction, which I'll elaborate on, but the primary objective is really to reduce the gearing. And just to put some numbers to that, so after the transaction, we expect the gearing to fall from 42.6% to 35%. In terms of our active capital management, so over the period, we've seen a reduction in our cost of debt, and we've seen an improvement of our interest coverage ratio from 1.5 times to 1.6 times, and we'll talk more about that in the presentation. The key focus for us is really on growing our earnings, and over the period, we've seen a rise of 1.8% year on year in our DPU, or distribution per unit, to 1.8 cents. The performance at the property level has been resilient, and the valuations have risen by 2.2% over the year. And this is largely driven by our Singapore assets. The rental reversion in the retail portfolio is just over 10% for the year, and we've also seen a positive uplift in our properties in Milan of 1.7% over the period, in line with the inflation. In terms of our strategy, so when I met with investors at the last quarter, so our Q3 update, I committed to review and assess our strategy. And I'm pleased to note that we will continue to focus on our core strengths. And we consider that to be really our competitive advantage of our focus on Singapore. As we've mentioned a couple of times, where nearly 90% of our portfolio is in Singapore. We're really focused on the high quality assets, which are the best assets in their precincts. And those are precincts which we would want to own assets for the long term. In addition to that, we'll look to focus look to collaborate with our sponsor. And as I mentioned, they've been in Singapore for 50 years, and they actually have quite a large portfolio of assets in Singapore, which at the right time, we could work with them on potential acquisitions. And the final element just to mention on is we'll look to continue to recycle capital from our non-core assets. And so if we consider Singapore to be our core portfolio, those assets outside of Singapore, we would look to divest at the right time, depending on the market conditions. So in terms of the divestment of Gem Office, so this is really important milestone for Lendlease REIT and something which the market has speculated about for some time. So we announced last week that we've entered into agreements to sell the asset for 462 million, which is in line with the latest valuation from Jones Lang LaSalle as at the 31st of July. As I mentioned, the net sales proceeds will be utilized to repay borrowings, and that transaction is anticipated to complete before the end of this calendar year, so before December 2025. There's a gain which will come from divestment of about $9 million, and this is calculated on the basis of distributable basis, and so we intend to make that available for distribution to our unit holders. The key rationale for the divestment is to reduce our gearing. So our gearing has been relatively high compared to some of the other REITs in the market at 42.6%, and after the transaction, we expect it to fall to 35%. The result of a transaction will really mean that our portfolio is very focused on Singapore retail, which is a sector which we feel passionately about and we feel has got good, strong fundamentals going forwards. Maybe I'll run to the next slide, which is the key portfolio metrics. So as you'd expect, if you follow Lendlease REIT on a quarter-by-quarter basis, these metrics remain largely unchanged over the period. So our portfolio occupancy remains very strong at just over 90%, so 92%. Slightly lower in the office portfolio. That's driven by the leasing work that's taking place in one of our buildings in Milan. The weighted average lease expiry, or WALE as we call it, is more than 7 years, which is one of the strongest in the market. We've got great tenant retention at more than 80%. In terms of our office rental uplift, so we've enjoyed a 1.7% increase in rentals there. And in the Singapore retail portfolio, the retail rental reversion is more than 10%. There's no change in our sales. Unfortunately, the sales are down 5% year on year, and we'll talk through that later in the presentation. I'm going to hand over to Lay Ting, who'll just run you through a couple of slides on the key financial metrics and capital position.
Thanks, Guy. So if you look at this slide here, the table at the bottom there lays out the key financial metrics that we have for FY25, second half, as well as the full year. So maybe if we look at the second half results first, which is the darker green columns here, registered gross revenue of 103 million and NPI of 74 million are respectively 1.9% and 2.7% higher on a year-on-year basis. Unfortunately, our NPI for the second half had been impacted when we terminated the Cathay lease earlier in March this year. However, we are fully provided for the outstanding arrears as at 30 June 25. For the second half of FY25, we will be distributing 1.8 cents, as Guy mentioned just now, which is 1.8% higher on a year-on-year basis. This is supported by the overall higher NPI despite the impact from Cathay, as well as coupled with lower interest rates in the second half, and both have contributed to the higher DPU. Then if you sort of look on to the next two columns on the white columns, so these are the full year results. Gross revenue and NPI looks lower because back in 2024, there was an upfront recognition of supplementary rent from Sky Italia. So maybe a bit of background for those who are less familiar with Lendlease REIT. Back in December 23, we had restructured the lease that we have at Sky Complex in Milan, which is one of our assets. Sky Italia, who was the tenant of all the 3 buildings there back then, handed back one of the buildings, and in return, they paid us an upfront amount equivalent to 2 years of rent. From an accounting perspective, this was recorded in full in FY24. But for more like-for-like comparison, because it's supposed to cover 2 years of rent, if you straight line this supplementary rent over the 2 years, gross revenue in FY25 would have been 1.1% higher, while MPI is 0.1% higher. DPU for the full year is 360 cents, which is 6.9% lower compared to FY24. So besides the negative impact I mentioned just now from Cathay, one of the key reasons is because FY24 still had a quarter of an old Euribor hedge, which was a very favorable fixed rate. That Euribor hedge has since been replaced in October 23. So maybe if we turn to the next slide. So this lays out the total assets and liabilities as well as net asset as at June 25. Total assets at 3.9 billion is higher mainly due to revaluation of properties that we have on annual basis. In FY25, we have revaluation surplus from our investment property, which is contributed mainly by the Singapore assets. The increase in total liabilities, on the other hand, is due mainly because we had an 80 million loan drawdown to part finance one of the PERPs which was maturing in 25, which you can see in the row below under perpetual securities holders funds. You will see that it dropped from 400 million to about 320 million. I can talk through a bit more on this when we get to the capital management slide. Overall net assets remain pretty stable at about $2.1 billion. And the number of units issued is standing at about 2.5 billion, which brings us to NAV per unit of 75 cents. So if you flip to this slide on capital management, during FY25, we undertook a key capital management initiative in relation to a tranche of about 200 million PERPs, which was maturing April 25. As a strategic move to optimize our capital structure, we refinanced these 200 million PERPs partially with 120 million new issuance, as well as remaining 80 million with loans. And consequently, the overall cost of financing has been lower as the old PERP was at 5.25%, is now replaced with new PERPs at 4.75% and loans at a lower borrowing cost. With this refinancing, our gearing as at 30 June has increased to 42.6%. However, part and parcel of our capital management strategy is to undertake capital recycling as well through targeted asset divestment, which, as Guy mentioned just now last week, we announced the sale of the GEM office component. So when completed, we are going to utilize the net cash proceeds to predominantly repay loans, which will henceforth bring the gearing down to 35% on a pro forma basis. Maybe other key metrics to point out in the table. Our weighted average cost of debt for the full year is 3.46% and has been marginally lower because we have benefited from yet another quarter of lower interest rate. And together refinance PERP, the ICR is also higher at 1.6 times. We will continue to work actively to improve the ICR ratio, and we laid out our steps in the two white boxes to the right of the table. Maybe a bit of information as well. This ICR ratio is stipulated by MAS to be calculated on a rolling 12-month basis, meaning that this ICR is calculated for the period from 1st July 24 to 30 June 25. Henceforth, some of the positive contribution from the steps I've taken will need time to build in, essentially. For example, the PERP refinancing we did back in April 25 will take another 3 quarters or so to actually see the full year upside. And as laid out in the second box, we'll continue to engage in active asset management strategy. We'll continue to drive performance of the Singapore malls as well as push forward on the leasing of Building 3 in Milan to drive the ICR further up. If we turn to the next slide, so this chart here on the slide provides an overview of our debt maturity profile, which you can see that is well spread out to minimize refinancing risk. In terms of activities during the year, back in December 24, we secured a 560 million loan facilities to target the refinancing of loans in calendar year 2025. So 420 has now been drawn during April 25, which was to refinance maturing loans as well as the PERP I mentioned just now. A remaining 140 million remains available to refinance borrowings maturing in September 25, which is about a third of the first bar that you see in the chart here. The other two-thirds is a 200 million loan, which is only maturing in April 26, which is more than half a year away now. We don't foresee any issues in refinancing, especially given that our available debt facility will be significantly higher post the GEM office sale. So I think the next slide just lay out some dates in terms of distribution, which I wouldn't go through here. Maybe I might hand over back to Guy to talk about the portfolio performance.
Thanks, Lay Ting. So we've just commenced the year, as I mentioned, our financial year ends 30th of June. So some of the numbers here are just reset. So when we look at our lease expiry profile, we have about 10% by NLA and 16% by GRI due for renewal in this period, which is a fairly typical year for us. And as you would imagine, we've already commenced lease renewals so far. Our WALE, as I mentioned earlier, is just over 7 years by NLA. After the sale of the GEM office, we would expect that to drop to just under 5 years or so, which still remains very strong. And as you can see from our tenant base, the government is our second largest group or tenant specifically at 12%. And when the GEM office is sold, since the lease is to the Ministry of National Development, then you'd expect those statistics to change as well. In terms of the retail portfolio, so this is reporting numbers quite similar to what we reported in the last quarter. So our rental reversion on the retail portfolio is over 10%, which is a good year and reflects the quality of our assets in the portfolio. In terms of our sales, and unfortunately the sales is down 5%. So this is the underlying tenant sales. And maybe just a recap on how we calculate our sales. So we calculate our sales for the assets on a like-for-like basis, so the total sales in 1 year compared to the total sales in the previous year. We don't make adjustments for tenancies which are under refurbishment or under vacancy, nor do we add in or take away properties which have been acquired or divested over the period. So when we compare some of the REIT sales numbers, it's not always easy to compare like with like. I think as we explained previously, probably the key reason for the reduction in sales is a couple of things, and we would probably attribute a large amount of that to be the tourism. So Singapore has not yet fully recovered in terms of the tourism arrivals, so inbound tourism, and then given the strength of the Singapore dollar, we've experienced a lot of outbound tourism as well, and so those sort of flows of people, visitation, and spend impacts on retail. And I think this is a consistent theme you'll see across the market. In terms of our visitation, so we had quite a strong quarter actually in the last quarter, particularly driven by visitation at 313 at Somerset. So the year we ended slightly up. And I think if we look at the last quarter, a number of things happened, but visitation due to tourism was higher. And part of that was driven by a number of concerts that took place in Singapore over that period. I think we now move on to some of our new offerings and new retail offerings. So we've welcomed a number of new tenants and promotions over the period, which is all part of our asset management strategy to keep them more refreshed and relevant to shoppers. In particular, you'll note a number of F&B tenants there. As I mentioned earlier, F&B is a key part of our portfolio. It's also, from a marketing perspective, it's the 4th year of You Won't Believe It's Trash, which is our collaboration with local artists to promote recycling. And this year the theme is cosmetics. In terms of the office portfolio, I mentioned the GEM office sale on the left-hand side. On the right-hand side, so just for context, we own 3 buildings in Milan. 2 are leased to Sky, and one of them is under lease up at present. We were hoping to announce more progress in leasing on the building 3. It's currently leased about 31%, but we've now hit the Italian summer, so we look forward to announcing some more progress after the summer. In terms of valuation, so the portfolio grew, or the valuation rose by 2.2% year on year, which equates to about 81 million Singapore dollars. I think more than half of this came from GEM Retail, which really reflects some of the strong rental reversions that we've touched on in this presentation. We also saw an increase in valuation in the Italian properties. Part of that was driven by the strength of the euro, and part of that was effectively the valuers recognizing the capex that's been spent on those assets over that period. In terms of sustainability, so we look at sustainability across a number of different metrics, but one of them that we actually look at is regarding safety. And we have what's called the global minimum requirements. So people often think about safety as being a key matter affecting properties under construction or under development. But given the number or the huge volume of people that come through the retail malls every year, we take safety of our visitors incredibly serious. So we just announced the new 2025 global minimum requirements. We put those online. We make them available to all parties, including our competitors, so that they can look at how we think about safety and what we do to ensure that we have a safe visitation in our properties. In terms of strategy and key priorities, Did we skip a slide? There we go. Okay, so one of the things I mentioned when I took over the role as the CEO, the manager, was that I would review our strategy and our competitive advantage. And I've just outlined some points here. So as we've said a few times, so we're really Singapore focused. 87% of the portfolio after the sale of Gem Office will be in Singapore. We're very focused on asset quality and precinct dominance. So 313 at Somerset dominates its precinct, Gem in Jurong East, and both of those are very strong precincts that we would like to invest in and grow. In terms of long leasehold tenure, so the assets in Milan are freehold assets, the assets in Singapore are leasehold assets. We think it's important to have a high leasehold tenure. We think we have one of the highest leasehold tenures in the REIT market. We think that's important. It reflects the age of our assets as well. They're both relatively new compared to others. In terms of operating expertise, so Lendlease has been operating retail malls in Singapore for more than 20 years. We're very proud of the team that we have. Our leasing team is about 20 people or so. We do most of the leases ourselves on the retail portfolio. And that sort of contributes to one of our points of difference from an operating perspective. In terms of our sponsors, so Lendlease is the sponsor of Lendlease REIT. Lendlease owns just under 30% of Lendlease REIT, and as I mentioned earlier, has been active in Singapore for more than 50 years. And we're very fortunate that we have a pipeline, or they have a pipeline, which we can look to acquire in due course, market conditions permitting. So that's probably our competitive advantage, and I think that it just reiterates the fact that we will be focusing on Singapore for the foreseeable future in our business. In terms of our key priorities, so I think probably the one to spend to reiterate the most is just the focus on sustainable income growth. So as you've seen, we've got good resilient earnings within our core portfolio, and really our priority is to drive those and continue to grow those earnings, specifically in Singapore, but also in Milan. As I mentioned, the building 3 we need to work hard to lease up over the coming months. In terms of our strategy, so as I mentioned, we're very much focused on Singapore, which has two elements. So one is exploring opportunities to exit the Milan assets at the right time, capital markets permitting, but also to look at the right time potential acquisitions in Singapore, which is our real focus. And as we mentioned earlier from Lay Ting, the active capital management. So just managing our interest rate exposures and managing our interest coverage ratio is really important as well. So I think that sums up the key priorities. Very happy to take questions on this presentation or the other materials. Hand back to Gerald, who I think will facilitate for us.
Yes, thank you, Guy and Lay Ting, for the presentation. I already see quite a number of questions coming in through the Q&A. So once again, for the participants who have joined us today, if you'd like to ask a question, do put in your live question in the Q&A box, and we'll be taking some of these questions during the Q&A session. Okay, so I think you gave quite a comprehensive update around your portfolio, some of the key strategic plans. So I will start with some questions around your Singapore portfolio, since that represents the bulk of your assets. There's a pre-submitted question here about Parkway Parade. You currently have a 10% interest in Parkway Parade. What are the plans relating to this? Any intention to be able to raise your stake towards Parkway Parade?
Thanks, Gerald. So Parkway is one of many people in Singapore's favourite properties. It's a property that the Lendlease Group has managed and owned for, I think, 25 years since we acquired that. And over that period of time, we've really added value to that property through a series of asset enhancements where we've created new precincts and really responded to, I guess, changing preferences within the trade area. And if you go to Parkway, you'll see that the trade area or the immediate vicinity has become more dense and has become more affluent over that time. And Parkway really hasn't had much competition. Also, in the last 12 months, we've seen the opening of the Marine Parade MRT, which has been really helpful, and I think will benefit them all in the future. So if you go back in time, I think it was about 2 years ago, the Lendlease REIT acquired a 10% interest in Parkway Parade, and really the rationale was such that if it could, so sorry, let me start again. So Parkway Parade is owned by a number of investors, and Lendlease REIT acquired the interest with the intention that if those investors look to sell their interest in the future, Lendlease REIT would be in a position to buy, and so therefore increase its stake in Parkway Parade in the future. I think just to manage expectations, the other two large investors who own that asset have actually owned that asset for quite a long time, and I don't think that they would be in a position to sell in the immediate future. But notwithstanding that, it retains, I guess, some kind of option value for the REIT to acquire in the future. So I think when you look at the size of that investment, it's quite small compared to the size of our overall portfolio, but it gives us that opportunity in future.
Okay, so we have gone through one of your assets, and I think you're right that it's very popular amongst those who are staying in the East.
Yes.
But I think what we have observed generally within the retail segment in Singapore is that if I were to read the news, there seems to be pressure amongst tenants within particular segments. We see quite a number of F&B companies actually closing down. So there's this question by one of our participants here, just relating to your general outlook on the retail segment in Singapore. How do you see that actually developing over the next 3 to 5 years? And in particular, with the RTS that is coming up, maybe those who are staying in the East may not be going up to Malaysia that often, but how would that actually impact the general retail scene across Singapore?
Yeah, thanks for the question. There's two parts there. One, I'll take on the general outlook and some of the articles recently in the press regarding trading of certain F&B and certain other retailers. And secondly, regarding RTS and the impact that might have on retail in Singapore. So just in terms of your first question, so like, our job as a retail mall owner is to make sure that our malls are vibrant and respond to the interest and consumer needs. And those evolve, and they evolve over time, and they evolve quite quickly at some instances as well. So we obviously take great care in our retailers performing well. If they perform well, then we perform well, and that's a win-win. That's a success as well. But unfortunately, not all retail tenants will be able to sustain performance. Particularly in the F&B industry, we often see brands will come and not succeed and then move on. I think our portfolio, with a few exceptions, has been quite stable in terms of our tenant resilience. I think not all retail malls are equal. Some retail malls are better than others, which can be as a function of their size, their scale, their catchment area, their connectivity, and their management as well. So I think I think not all retailers are equal. Not all retail malls are equal. We take great care to work with our tenants to help them when they struggle, and if they can't continue, then we look to replace and improve our offering. I think with regards to your second question, which is about the RTS, so we don't know exactly how that will play out just yet. We do know that at the moment the sort of the opportunity that Malaysia offers to shoppers is really probably one for the service industry, and it's probably more of a destination just given the time that it takes to get there. So it probably means that certainly malls which are closer to the border might be more impacted than those which are not. Those where you would look to spend the whole day there might be more impacted than those where people will frequent them more often for a convenience basis as well. And certainly, if we look at if it's hair salon or nails or massage, those kind of services are cheaper in Malaysia. But that doesn't mean that all experiences in Malaysia are cheaper. So I think we have to watch that space. It's again another reminder why we need to keep on our toes and make sure that we really listen to our retailers and listen to our consumers and keep our offering fresh. But it's something that we'll be monitoring as we move forward with the RTS in due course.
Okay, next we move on to Somerset 313. I think we have got a number of participants who actually follow your portfolio fairly closely. So two questions here around any updates on the multifunctional event space at Somerset.
Yeah, so we will be working on the name multifunctional event space. It's not the most snappy name, but that's sort of the internal name. I think internally it's called Project Live, which is what we use as a code name, but externally it's the multifunctional event space. So just for those who are not so familiar, this is the car park, which is open air car park just next to H&M, between H&M and 313 at Somerset. So we have a partnership with Live Nation to develop a concert venue. I think the capacity is about 3,000 people. Live Nation's plan is to have events, most evenings during the week. I think it's super exciting for the Orchard Precinct, super exciting for 313 at Somerset. It's from our perspective, it's a relatively modest financial investment, but just in terms of bringing people to the precinct, bringing new shoppers, new diners, that's really why we're doing it. Live Nation's a fantastic partner. I don't know how well you know them, but they really are one of two concert promoters globally. And so we're excited about the events that they'll bring. In terms of the latest status, so I think my last update was that the piling work had been completed, which is great progress. So which we'll start to see more coming out of the ground in the coming months. And I believe that they're on track to complete the project in the second half of calendar year 2026, so a year or so from now.
All right, so we'll await your updates on future corporate connects as to the status of the multifunctional event space.
Yeah.
I think one of the key developments that you mentioned earlier was really the sale of the GEM office. Um, in the past few months, we have actually seen a number of other REITs actually acquiring assets, given the expected decline in interest rates. But you have gone the other way to actually sell this asset at this point in time.
Yeah.
Can you maybe share a bit of your thoughts around why divest this asset at this point in time? What was the process around it, and how will this potentially impact your future rental income?
Yeah, okay, great question. So thank you. There's a few components to that. So we really like the GEM office. Lendlease developed GEM, both retail and office. We effectively built the building to the M&D's requirements. And so we're very proud of that and have a great relationship with the M&D and the BCA, who's the existing user of the space. Why are we selling rather than buying? So I took over the role on the 1st of April, and from my perspective, it's really important to listen to our investors. I consider our investors to be our clients, and I think the overwhelming feedback that we received was that the REIT's gearing was too high. I think in the REIT industry, 40% is really a key threshold for REIT investors in terms of their tolerance level, and our gearing, as you can see here, was standing at just above that. So we took the decision that we needed to bring that down to really address the concerns that investors had. And in terms of our assets, we felt that this asset, given that we'd just been through the rent review, given the deal size wasn't so large, and given that perhaps the future growth might be different to what you'd expect from a retail portfolio, we thought that it could be a good transaction to really improve our gearing. So we ran a process. We appointed a number of agents, and we haven't announced, but there's a separate announcement made by the Keppel Group that the Keppel Group and parties associated with them have bought the asset. They participated in the process, and the terms and price was attractive, and so we accepted those terms. And then over quite a short period of time, we converted that from an offer to a sale contract. And they were a great pleasure to work with. So we announced the signing of the contract in last week, so 4th of August, and that transaction will close towards the end of the year. We put out a separate document, which is the SGX requirement for the divestment. So if you refer to that, there is included in it a pro forma impact, and the way that that's calculated is referring to FY25. And the assumption is that the asset is sold on the 1st of July 2024, and that's per the SGX rules. And on that basis, the transaction is mildly dilutive. So I think the number is 2.2% dilutive to the period.
Okay, maybe then to explain what this potentially means to investors would be that if this sale of the asset had taken place at a point in time, then we might be looking at potentially a lower distribution per unit versus what was actually reported.
Yeah, Lay Ting, do you want to take that one? Yeah.
Yeah, I think like what Maya mentioned, this is per the listing requirement that we have to assume that the sale happens on the first day of the financial year, which is 1st July 24, and henceforth the pro forma are calculated on that basis. So imagining on the first day we have sold the asset, then the DP would be, as Guy mentioned, 2.2%, marginally lower than what we actually distributed in actual.
Okay, so given the sale of this asset and the potential impact to your distribution per unit, is there any way that you can drive growth in your distribution per unit through your remaining portfolio of assets?
Yeah, it's a great question. So we don't provide, I guess, forward-looking statements or guidance on earnings. It's something which I guess the Singapore industry generally doesn't. But what we can say is probably the following. So the portfolio is dynamic. There's many parts to it, and there are risks and opportunities to earnings. And as you mentioned, one of the risks to earnings is the dilutive impact of the gem office sale. And then there are opportunities to the earnings. And so the opportunities to earnings are resilience in the retail portfolio, the core portfolio in Singapore. It's also the reduction or further decline in interest rates as well. And then finally, we've got the potential, we've got the disposal gain on the transaction. And those things together create opportunities. And I think as management, we are confident that the opportunities exceed the risks as we look forward.
Yeah. And also to mention the refinancing of the perps that I was explaining just now.
Yeah.
So in FY25, the perp, most of the year, about 9 months, almost 10 months of the year, it was still at 5.25% for 200 million. So we've now refinanced out the 200 million. Now we only have 120 million at 4.75%, which is slightly lower than the 5.25. And also 80 million is refinanced with loans, which is at a lower cost of borrowing.
Okay, so I think we've gone through your Singapore portfolio. Next, we'll go to the other 10%, which is the Milan asset. I think there are quite a number of questions here around what is the outlook like for the Milan asset. They appear to be fairly challenged. Is there any way that you can actually bring up the occupancy rate for this asset, particularly the leasing activity for Building 3?
Yeah, so just to put it in context, so as you mentioned, roughly 10% of the portfolio is in Milan. It's good to explain, I guess, the context of why we have the Milan assets in the portfolio. So when the portfolio was listed back in 2019, the cost of funds in Europe was very low. And by adding European assets with a long WALE, it was able to boost the distribution per unit and increase the WALE or weighted average lease expiry on the portfolio and create more of a bond-like income. That was 3 buildings, and they were all originally leased to the Sky Group as the Sky Italia headquarters. I think a couple of years ago there was a lease restructuring. Sky decided that they needed 2 of the 3 buildings, and a deal was effectively done around that, which meant that they provided a supplementary rent to cover the vacancy which was taking place, and that supplementary rent expires relatively soon. So since that point, the team have been focused on refurbishing the property and then releasing the property, which is what they're doing now. So just for clarity, there's 3 buildings. 2 of them are fully leased to Sky on a long-term lease. The 3rd building, which is the so-called Building 3, is about 30% leased at present, and the team are working hard to lease that up. So when you put it in context, it's a relatively small exposure in the portfolio.
Maybe you can share with us some updates around the leasing activity that you see for Building 3. What are the kind of tenants that you're looking at? How do the rents compare to the existing rents that you have for Building 1 and 2?
Yeah, so for those who've been to Milan, you probably went downtown to the Duomo or the city centre, which is really comprising of fairly old buildings, which are relatively small and have been through refurbishment processes and so on. The buildings that we have are in a decentralized area. I guess you can think about it a little bit like how PLQ is relative to, or High Labour is to Singapore, to the CBD. So you've got grade A buildings, big floor plates, you've got great connectivity through the train and through the underground, and you've got great sustainability characteristics. So Probably the target tenants for our Milan buildings are slightly different to what the target tenants would be downtown in Milan. It's a larger user, it's someone who needs a bigger floor plate and so on. So in terms of the current leasing, the 30%, we've got tenants which include, I think, commodities, we've got a school, we have co-working or flexible office space. In terms of prospective tenancies, we're looking at all sectors, so it includes technology, includes telecommunications, real estate, construction. So it's quite diverse in terms of its pool, but probably more catering for those tenants who are in surrounding areas who want to consolidate or surrounding cities, as opposed to sort of pulling people from the city centre. In terms of numbers, which is the next question, so the rent, which when we leased the building to Sky, was lower than the rent that we are getting when we lease to other tenants. But the floor area when leased to Sky is greater because they took the whole building. When we lease to multiple tenants, the floor area is less. And so if you take the higher rent of a lower floor area on building 3, I think net it's roughly the same as, or it will be, or we target it to be roughly the same compared to the previous tenancy. Lay Ting, have I explained that correctly? Yeah.
Okay, and I think previously you shared that you consider divesting this asset if the conditions are right. So you shared what was your thought process behind divesting Gem Office. What are some of the considerations that you would actually bear in mind when thinking about whether it is the right time, right price to be selling the Milan asset?
Yeah, with the exception of building 3, buildings 1 and 2 give great income, and they've got a strong WALE. So we need to balance the income, and we need to balance the market situation. So the Italian markets are perhaps not as liquid as, say, the Singapore market is today. Even the European markets more broadly, even the London market is still not back to its full liquidity. So I think we need to balance sort of liquidity in the market versus portfolio income. But I think ultimately, those on this call, I'm guessing most people would appreciate that the REIT is largely focused on Singapore, and I suspect would like to see that happen more going forwards.
Okay, so we have covered Singapore, we have covered Milan. We have quite a number of questions around capital management, which we briefly touched on earlier. I think you mentioned the perpetuals. So I think first and foremost, if we were to look at the cost of debt, how are we thinking about that going into the second half of this year, 2026? Any sensitivity that you can share around how that can potentially help to lower your financing cost?
Lay Ting, I'm going to ask you to take that one.
So I think maybe the first thing to mention is that the number that you see in this slide, about 3.5% for FY25, it's for the average rate for the full year, which is from 1st July 24 to 30 June 25. And Gerard, like I mentioned just now, the interest rate in Singapore, or the yield, bond yield, or even the SORA only probably started coming down towards the later part of 24, and more significantly in the first half of this year. So that number of the average debt cost still has about 4 or 5 months of higher rates, essentially. So going forward, I can't really predict where the interest rate might go, but based on current levels, definitely we have savings. If you look at the table again, I think 68% as at 30 June is hedged borrowings. So we still have about 32% which can benefit from lower interest rates, which we will be based on the current rates. So if you ask me about the average cost, we are hoping that with the benefit of the lower floating rates, it will go to the lower end of the 3%. And I think the other thing to mention is probably that when we repay the loans from the GEM sales proceeds, one other thing that we'll do is also to review the overall hedge portfolio as well and think about strategies to optimize that.
Okay, I think there's one question relating specifically to your 285 million term loan due in FY26. How are you looking at the refinancing for this particular term loan? Any expected cost savings when you refinance this term loan?
So out of the 285, as I was explaining just now, 120 million, we have already secured the refinancing. So if you look at that bullet point there, we actually have secured the refinancing back in December last year. So there's still another 140 million, which is going to kickstart soon so that we can refinance out part of the first bar, your 285 that I mentioned here. The other 200 million is only coming due in April 26. If you ask me whether there are savings or not, at least based on the 140 million we have secured, I can't exactly share the exact rates because these are negotiated with the banks, which the banks will not let us to share due to confidentiality. But we do have some savings in terms of the margins that we get from the banks when we refinance out this 120 to 140 million. So the other 200 million is only due much later in April 26. So I do expect that we can get some savings. But then, as I mentioned, we're going to have sufficient debt facilities when we repay the GEM office, when we use the GEM office sales proceeds to repay loans. So potentially, we actually don't need to go out and secure another new facility.
Okay, thank you for sharing more about your capital management strategies. I think we have gone through the Singapore portfolio, Milan asset, capital management. I think maybe just to round up tonight's session, I think quite a number of the participants tonight have noticed that your share price is still trading at fairly low levels. So maybe to round up, can we get some thoughts around how we can potentially unlock value for unit holders? How can we think about being able to drive DPU growth going forward and allowing the REIT trading to trade closer to its book value?
Yeah, thanks for the question. So we obviously have no control over our unit price. We can only take on board the feedback that we receive from investors and execute upon that feedback, and then look to see what happens with the unit price. So, as I mentioned, on the 1st of April, I took over the role. The key feedback was that our gearing was too high, so we've taken decisive steps to bring down our gearing. And so when those proceeds come in, that will reduce the gearing. So that's the first thing that we can do. The second thing, as you touched on, and it actually was the second feedback we received, was to stabilize DPU and look for DPU to grow going forward. So that's the key part of the work that I'm doing, working with Lay Ting and the team upon. So as you mentioned earlier, when we look at the outlook, we feel positive about the outlook. We think that the opportunities are greater than the risks going forwards. So we feel positive about that. And then the third thing that we can do, and we are doing, is engaging with investors and a wide group of investors to share what we think is good news and is good results and a good outlook. So we can do that today. We do that with institutions. We do that with the research analysts. And in fact, I think we're covered by 8 research analysts. I think 6 are now buy, 2 are neutral. Last week, one of the analysts converted from neutral to buy, so that's good progress as well. So then you touch on our unit price. So I think we feel positive, we feel optimistic as we go forwards. We are trading a material discount to book value. We are a smaller REIT than some of the other REITs, so we're probably a mid-cap REIT, I would say. And if you look at, I think earlier, Gerald, you had a slide which showed some of the performance in the last 12 months or so of the REITs in the sector. And certainly we've seen some of the bigger REITs, more liquid REITs have performed well. And I guess the question is, at what point does that liquidity flow down to the mid-cap REITs and so on, and does the good news get recognised? So we'll watch this space on that.
Okay, so I think we have answered all the questions for tonight's session. Guy and Lay Ting, any final words for our participants tonight?
Look, thanks for taking the time today. Always appreciated, and we very much value your feedback. It's your trust. If you are a unit holder, you're a unit holder of the trust. We consider you to be our client, and we value your feedback. We take on board that, and we'll act upon the feedback that we receive. So, thanks for your time, and we look forward to speaking again.
Okay, thank you, Guy, for sharing the updates. Even though you've just come on board since April, I think it's good to hear your thoughts around the assets of the REIT and some of the strategies going forward. Thank you, Lay Ting, as well, for giving us an update around the financials and answering the questions relating to the financials of Lendlease REIT. So I hope the participants of tonight's Corporate Connect session found the session informative. If you missed any part of tonight's session, you can rewatch the webinar on SIAS YouTube channel. Our next Corporate Connect session will be this Thursday, the 14th of August, and that will be with 17 Live Limited. So thank you once again for joining us this evening, and I hope you have a very pleasant evening. Thank you.
Thanks, Joe. Thanks, everyone.